I'm Josh Sigmund, and I'm a mortgage lender. I'm also a geek for money, not just earning it and saving it, but literally everything about it. I love that money has rules. It has its truths. I love investment strategies, and I love making money work for us. For so many, money is emotional. For me, it's logical, like a puzzle. My passion is also helping others with their money. I love looking at people's finances, dissecting their puzzle, and rebuilding with strategy and purpose, and I'm really good at it. I'm making this podcast about my money strategies, not the things that are written in books or sold in programs. It's a podcast outlining the lessons I've learned and used for the past 15 years. These strategies help me and those who use them save more, give more, create wealth, and retire early. Let me teach you how to build your net worth. You ready? Welcome to Sigmund Sense. Well, hello, everybody. This is Josh Sigmund, and we're here for another episode of Sigmund Sense. And I feel very lonely and weird staring into this camera right now because we are practicing social distancing. And so I am now in an empty room with no stage hands. I don't have my producer, my editor. I don't have my cohort. Bryn is not in the room. We decided that's just safer to play by the rules. And so I'm going to attempt to not make this too awkward for you, but the show must go on. And so here we go. So in this episode of Sigmund Sense, what we're going to be talking about is really real estate in general and real estate investing and the different types of real estate investing and what that might all look like, the key players involved. It's one of those things I've been doing for years and years and years. And, I guess it's somewhat easier for me because I'm in the industry. So I kind of know more about the different aspects. But what I would tell you is that it's not that it's not learnable. I will tell you that real estate is an excellent place to make money. And for sure, it's a place that you can lose money too. So, that's your buyer beware. There's a couple of great books. I'll just tell you how I got started in it personally. So even though I was already in mortgages at the time, one of the first books I read was Rich Dad, Poor Dad, Robert Kiyosaki. And that's probably what got my eyes turned towards real estate in the first place. Another thing that I've noticed and read over the years is that the vast majority of wealth created in America was a couple different ways. It was either someone that invented something, right? They were born into it for sure. But the primary, something like 70% of millionaires were created through real estate. Whether you like him or not doesn't really matter to me, but look at the Trump family. Trump family did so through real estate as well. They made millions, they lost it all, bankrupted, and then, obviously made it all back, and primarily through real estate. So all that to be said, it's, one of the questions is, well, where do I begin? What should I know? What are the pitfalls? What should I look out for? And what are the types? And so I thought for the next 45 minutes to an hour that I would just take the time to kind of walk through that. I can share some of my own stories. I have had mostly wins. I have had losses, and kind of walk you through how that works and kind of what to look out for in hopes of helping you stay away from stepping on your own landmine, right? But when it comes to real estate, you need to think with the end in mind. It's what are your goals? Thinking it's got to be an unemotional approach to money and an unemotional approach to real estate. Because one of the things I remember early on is in my first couple of flips or properties I bought for rental properties, I was looking at it with the wrong eyes, meaning that I'd go into it when I was going to paint it or stage it or whatever. From the eyes of what I would want, I'd rather have hardwood floor than carpet. I'd rather have tile than carpet. I'd rather have one story than two story. I really would rather have a big backyard than a small backyard. And the truth of the matter is all those statements I just gave are emotional and they don't matter. If you're just thinking about doing it from a rental perspective. Now on the flip side, if you're thinking about flipping a property where you're going to buy a house, put some money into it, fix it up, rehab it, whatever, and then put it back on the market, those concerns might matter more. But to a point, you still have to measure the money, which is a logical approach, not the emotional side of what looks pretty, right? And so the starting point I think to think about is how do most people get into rentals? So one type of real estate investment is obviously amassing rental properties. And rental properties, obviously the goal, not always, but the goal is to cash flow, where whatever your mortgage payment is on that property, that you, of course, get more rental income than the mortgage payment, thus creating wealth monthly as far as cash flow. So you can add money back to your savings account, but also having somebody else pay off your real estate debt. So that works very well for a long-term hold. You buy a piece of real estate. What example I see a lot is people have kids. Yeah, a lot of people have kids, it turns out. And they know that in 18 or 20 years, those kids are going to go to college. And so what they'll do is they'll buy a piece of real estate now in a college town that they think that their kids might want to go to. Here in Texas, it might be a College Station, or it might be, in UT Austin, or it might be way out in West Texas by Texas Tech. It doesn't matter. But they'll buy a piece of property to rent out to existing college students, and then aggressively pay on that mortgage so that by the time 15 years, 20 years goes by, ideally the mortgage is paid off. And now when a kid goes to college, they have the opportunity to live rent-free or get rental income from their friends so they can learn the power of money as well. A lot of people will do buy and hold strategies when it comes to keeping their first house that they bought. And so they'll buy a property, they'll move into it, they'll live there for a period of time, a year or two, and it's time to move up. But hell, that piece of property was great, and you might have bought a cheaper piece of property because of your first time home. And on top of that, maybe the area that you live in is appreciated, so you couldn't go get that house for the same price anyways. So all those things lend towards, well, a good piece of real estate, it's a good piece of real estate, let's keep it. And so people will hold on to that property and rent it after they leave. And that might be literally their first rental property, but it wasn't intended when they bought it, right? So buy and hold rental strategy for real estate investing is about making sure that you have a nut that you can cash flow or at least cover. So whatever that monthly payment is, inclusive of taxes and insurance, I hope you would account for upkeep. And certainly if you have a property manager, that has to go into the equation as well, along with potential a month or two that is unrented, right, during the transition periods. All that, hopefully with the right rental income, would be enough that the rents would cover all that and a little bit more. Okay, so that's more for buy and hold. Speculation type of real estate property is also something that people do. It's a higher risk, it's a longer term usually, but it's a higher payoff quite often. I've got a long-term friend of mine, one of the first clients I ever had, recently deceased. Last 2 years he's deceased, but what he did for 15 years that I knew him was he and a partner would go buy key corners. So when you think about, all cities, especially Texas, are all growing. Not all cities, I shouldn't say that. Detroit didn't grow for a couple of years there, obviously. But cities that are growing, you start to see where the next streets are going to be. You kind of see where in 5 or 10 years, the city will grow and envelop the next kind of area. And so from a buy and hold, but more of a speculative strategy, what people will do is they'll go buy a key corner. So what this guy would do is he'd go look out in San Antonio before 1604 was 1604. Years ago, it was a single lane highway 25 years ago, all the way around the city, and it was the country, and there were ranches off 1604. Well, now people know in San Antonio that 1604 is just the outer loop, and now there's other loops outside of it, like 46 is basically turning into the next loop outside of San Antonio. But what he'd do is he'd go in that furthest out major thoroughfare in a key corner where a major road crosses a major road, but it's not yet developed. He'd go buy the acreage around those corners, thinking that in 10 years or 20 years, if the city keeps on growing around it, that's a great place to put commercial properties, great place to put a CVS, a great place to put a gas station. And so it's obviously another long-term buy and hold, but it's very speculative because in the meantime, there's typically no cash flow. So somebody who's going to buy that, they're either service the debt and out of their other monies, they're going to keep on making a payment on it, where they pay for it in cash, and they're going to sit on it for a long period of time, 3, 4, 10 years, for the properties around it or the city to kind of grow around it. But then all of a sudden that property is worth a lot. The reason why I say it's worth a lot in those types of cases is when you're buying key corners ahead of a city, what you're doing is you're paying for by the acreage price, but then you're selling it by the foot, right? So you can imagine if you're buying it for 3, 5, 7, 10,000 an acre, but then you end up selling it by the foot, not by the acre, for $5, $10, $20 a foot. Massive, massive, massive appreciation if you're right and you guessed right. And that's why it's called a speculative investment for real estate. Not advisable in general for the rookie, because you're in a position where you'll be paying taxes and upkeep on it for a prolonged period of time. And land in and of itself is typically pretty illiquid, meaning that if you needed to sell it, it's going to sit on the market typically longer unless it's already in a good position. Okay. So that's another one. Another type of real estate investing is flipping, right? So I'm sure everyone by this point has watched HGTV and they're all masters about what a house is supposed to look like. Listen, I've watched those shows a lot and most of them are idiots. There are some that are very good. Most are idiots. It's appealing to the Sunday night drinking wine on the couch and everyone can be a millionaire mentality. But the reason why I say lots of those aren't correct is because there's so much money being put into them to make them look amazing for the TV show that realistically the price itself wasn't a real profitable endeavor. And so I'm not poking fun at a specific TV show. I can think of about a dozen that I think are BS for lack of better terms. But there are a few on there and you get the point. The point is that you're going to buy a distressed house, a distressed sale, a property that needs repair, needs upgrading, that's super old or just didn't have the correct upkeep in the last couple of years by the previous owner or tenant. You're going to dress it up, put lipstick on the pig. You would hopefully get some sound advice from a great realtor or decorator. If you're going to add on walls or rooms, things like that, obviously you're going to have to talk to engineers and get some good architectural plans done. But the point is that you're going to take something that's not worth that much, put some lipstick on it and sell it for more, and ideally pretty quickly. Okay. This is an area I've been doing for years. I'll give you a couple of examples. My first flip ever was, I call it the Mamacita house. It was a small property out in the west side of San Antonio, out in Bronze Station area. I bought it for $50,000. It was a cash offer, bought it for $50,000, what it was. Somebody had died in the property. It was not a great property. It smelled like you can't believe. My wife will forever remember this because Christy remembers going in there because in our first property, she wanted to be involved in picking out the colors and the countertops and all that stuff. And we walked in and she's pregnant at the time. And she literally almost threw up on the floor, not from morning sickness, but because of the smell, and ran outside and said, well, you're on your own here. But if I were you, I'd probably pick these colors, right? What's interesting is I only put $7,000 into it because all we did was, again, here's the colors and here's the countertops. And here's, we had to remove bars from the windows because there were bars in the windows and put in some new appliances because half of them weren't working. But that was it. And it was $7,000 all in. So acquisition price is a word to think about. The price at which you acquire the property was $50,000 plus $3,000 closing costs. So the acquisition price was $53,000. The cost of repairs, another term that you're gonna hear a lot about, was $7,000. So all in, I was in for right at about $60,000. I put it on the market with a realtor within 30 days, and we sold it 30 days later. And so literally in less than a 90-day period of time, I sold it for $91,000. So in that example, I had a $50,000 investment, $60,000 all in, and I sold it for $90,000, making $30,000 on my 60, all within 90 days, which accounts for a very good cash on cash return on investment, which I'll explain momentarily. But for me as a cash investor, that was important to understand because I know that the faster that you can spend the money, the faster you can rehab and flip it, A, the safer you are, and B, the bigger the rate of return, right? So just using easy math, just basic math, if I had 60,000 involved and I netted 30 more, right? Then I had a 50% cash on cash rate of return. But that's on an annualized basis. So if I did that in 3 months and I could keep on reinvesting that money and keep on spending it, it's not a 50% rate of return on that money. If I can keep that money spinning, in theory, I could have a 200% rate of return over a course of a year if I can keep that money moving. So the velocity of money, the speed at which you turn it and get your money back and turn it again, the faster you do that when you're dealing with flipping, the better your rate of return on an annual basis. And so that's a super important concept that I lucked into and I learned early just by accident because I bought the right property. I'll tell you that the second property did not go so well, right? So the second property I bought was a property on the east side of San Antonio. I was trying to roll my money back out, and I bought a piece of property through a wholesaler. Didn't know the wholesaler, so there was no trust there. It was somebody that was referred to me. Seemed like a nice enough guy, so I did listen. I did buy the property. They had an estimate of repairs that were incorrect, and very quickly I realized that this was a POS, as in piece of shit. And the reason why I say that is instead of the acquisition price for that one was about 120, estimated repairs were 25, so I was going to be in for 125. Estimated sales price to sell on the flip side was going to be 150 to 160. I had just accomplished something similar, 30 days earlier. So I thought easy peasy, I can knock that out in a month or two and get it sold in 3, and I'll get another $25,000 return. Well, I got into the property, and of course I didn't do an inspection up front, which I'll talk about momentarily. And so it took me a second to understand that, oh, wait, there's a foundation issue. We fixed the foundation, which was like $12,000. But when you fix the foundation, it broke the plumbing underneath the house. Oops, there's another $6,000. Of course, when the foundation was also fixed, it kind of re-leveled the property, and it kind of broke corners of doors. Sheetrock was broken, so then I had to go back through, and instead of the easy paint job, I had to fix and fill seams and these big cracks that were created. And when it got to the end of this, all of a sudden I realized that by the time I'm going to sell this property with 7% closing costs between real estate agents and seller costs, I was going to make no money. I was within like $1,000. And so my wife still laughs at me to this day, but my buddy and I was in it with a partner. That my buddy and I sat there and we literally had to hand paint it because we were so close in the numbers. We knew that if we didn't hand paint it, we would actually lose money. And by the time we finished this project up, about a month and a half longer than it should have taken, at the end of the day, we both netted $500. Like, we didn't lose money, and you can't go broke making a profit. But I would argue that for all the labor and the time, the energy and the stress, all the third parties, the foundation guys, and all those guys made plenty of money. The plumbers, electricians, they all made their money. The realtors all made their money. The guy that sold it to me, the wholesaler, he made his money. And for all that, my buddy and I made $500 each. So that's the buyer beware. Now, you can't go broke making a profit, but that's not a good investment, right? And then I'll tell you a bad story. So I've probably gone through 50 properties at this time, between flipping properties, wholesaling properties, buy and hold that I still own, all the different types I've done, down to some speculation. And I've won in all but 3, but one of the 3 that I lost on was super, super, super ugly. And so basically I bought this property. I wanted to buy and keep a new rental property for a long term. It was in the right area. It had been completely rehabbed, and it wasn't done right. And so because of some negligence on my side of not getting a full appraisal inspection that ahead of time, because again, I thought I knew the actors involved. The reality is that a year after I bought the property, I got a cease and desist order from the city saying you can no longer rent this property out. We can see if there was some work done on the property. There were no permits filed when you rehabbed it. So I called the guy out there. Nothing is a big deal. Called the agent out there who was involved in the sale, the purchase, and all the rehab itself. And what we thought was going to be a slap on the wrist, couple fines, get the permits redone, ended up with in the order of $45,000 of losses and 1 year of lost rent, because I had to tear off all the walls. I had to move the water heater. I had to add a joist in the ceiling because the roof was caving in. I had to move the AC. Literally, I had to tear out everything that was done and redo it all, and lost the rent for the year, but still had to pay taxes, still had to pay insurance, still had to do the work to finally get back to where I'm able to rent it again. And so that property was only a $150,000 property. So you can't take a $35,000 bath on it for a year and expect to come out whole, right? So good, bad, and ugly. that's kind of the pieces of what happens with real estate investing. So let me tell you some easy things to do that are safer ways to do things, generally speaking. And then I want to talk about some players that you need to get to know, interview, and check references on before you really dive in all the way. Because we all know a little bit. It's not what we know that kills us in real estate investing. It's what we don't know. And usually, unfortunately, and every real estate investor will tell you the same thing. You learn quickly when you get an extra $5,000 slap in the hand or a $30,000 mistake done, or you end up not being able to sell a property because the valuation was not correct, done well up front, or the square footage wasn't right up front when you bought it from a wholesaler that you didn't know. So I would say the first and best way to get involved with real estate investment, believe it or not, is to buy a house to live in. So if you're watching this and you've never, and you're thinking about getting a real estate investment, but you don't own a home, the best piece of real estate you can own is the one that you live in. Okay. The reason why I say that is the rates are the lowest, the down payment is the lowest. You typically get tax breaks in each, depending on which state you're in. But for example, in Texas, if you live in the property as your homestead, then you get a little bit of a discount on the taxes. On top of that, if you happen to be over 65 or a disabled vet or 100% disabled vet for the extreme, they don't even have to pay property taxes on the property that they live in as their primary residence, right? So you're able to get into it and more importantly, get use out of it, right? So we're not relying on somebody else having to rent it from us. We're getting use from it. So we all have to live somewhere. I'd rather your money go towards building your equity than your money go towards building an investor's equity, if that makes sense. If you plan to move in less than 2 years, leaving the city, I wouldn't buy because there's too much risk in 2 years. Here I am sitting in an empty office by myself because guess what? COVID-19 that didn't exist 3 months ago or 4 months ago is now here. It's going to affect real estate prices a little bit. We don't know how bad or how far or what cities, but it's going to probably affect it. So somebody that might be planning to buy a house to live in it for a year or two and then leave the state, it's inadvisable in these kind of conditions, right? Now, if you're going to buy it, live in it for a couple of years and then leave and keep the property as a rental property, different story. That is totally an okay and a good plan in my opinion. But the first and best real estate investment you can do is to live in the property yourself. I'm going to be doing an interview with a guy named Abel. I'll call him Abel P for right now, but he's a client of mine that I met 12 years ago. And I remember he came in my office, he sat down, he'd never bought a property before. We had this exact conversation. He's like, I want to get into real estate investment. And I read all these books, and he does read a lot of books. And I said, well, first thing is buy one, live in it. And then the second choice would be move out in 2 years and go buy another piece of property and keep the old property. Okay. The reason is that you were able to finance a maximum amount on the old property. And you can now, as long as you can rent it out to cover your nut, you now have your first rental property that somebody else is paying to create equity and wealth for you. And you're moving on for another low down payment, 3% down or 5% down loan. The reason why I say this is the number one biggest reason why people can't get into real estate is down payment, and investment loans require a 20% down loan minimum. I shouldn't say that. There's some lenders that will do 15% down, but to get to good rates and good fees, 25% down is really the magic number. So planning on 20 to 25% down for a down payment is usually enough to stop people in their tracks from buying investments. But if you can buy your first house for 3% down or 3.5% down, or a veteran is 0 down, now you've gotten into the real estate game, right? And once you get into it, you get kind of hooked. You're probably in it for life. There's very few people that go into it for a couple of years and then they're like, screw this. We're just going to lease forever. Very few people actually do that. So now that you're in the game, you're building your wealth through your own payments or through somebody else's payments. You move on to that second house, that next house you buy. As long as you live in the property as your primary residence, you then again can do a low down payment or no down payment loan, right? There are 3 loan types. It's important to talk about this again as a reminder from an earlier session. But the 3 types are primary residence, second home, and investment properties. And it's really important to understand that this is an area of fraud, as in mortgage fraud, as in you go to jail and you don't look good in orange fraud, if you misrepresent the intent with a property. So do not tell a lender you're going to live in a property as your primary residence to get a low down payment or a lower rate and then never move into it. If you get caught, you will go to jail. So don't do that crap, right? But again, if you're moving up to your next house, so you bought your $150,000 starter home, now it's time to buy your $250,000 move up house. And again, you can move into as your primary residence. What the intent is to occupy that property within 60 days. And your intent is to not receive any income on that property at all in the first 12 to 24 months. Okay. Now, intent can change. So after 2 years, like I said, you're pretty safe. If you move out, you want to rent it to somebody, cool, go for it. But your intent at the time of closing that you're signing a legally binding instrument is why you can go to jail if you lie and commit fraud, is that you're going to occupy this property as your primary residence within 60 days. Okay. A second home is different. Same thing. It only requires 10% down, so you don't have to do 20% down. It has same rates or similar rates to primary loans. So it seems like a good way to take advantage of the system. But once again, dude, like it says that you intend to occupy this property for at least 2 weeks a year for you to live in, for you to reside in your second home 2 weeks a year, and that you don't intend to get any rental income on this property. Now, on second homes, if you think about like a mountain house or a beach house, yes, it is acceptable in most cases that if you need to rent it out to a friend for a little bit, or like if you have a winter Texan scenario where somebody rents for just the winter time, but then it's your second home all summer long, there are possibilities of doing loans that are second homes with that kind of thing in nature. But if your intent is to receive income, make this like a VRBO, short-term rental all the time, it's an investment property. It's not a second home. Don't commit mortgage fraud, right? And of course, the third loan type is an investment property. It requires more money down. The rates are higher. So here we are sitting at the first or second day of April when I'm recording this. You'll probably listen to this in a couple of weeks. But investment property rates are definitely in the mid to high 4s, whereas primary rates are in the 3s. And so don't be tempted to go for the lower down payment, lower rate by misleading your loan officer, because if you get caught, it's just really bad things. But those are the loan types and how you do it. At the end of the day, rates in the mid to high 4s, even low 5s are great rates for investment properties. It's just not worth the risk, right? So the first and second best ways to buy and get involved in real estate is buy your primary residence, keep it, then move into your second house. And a lot of people do this over and over and over again. There's some reasons, and I'm not a CPA, but from a tax perspective, there's something called short-term gains versus long-term gains, and it applies to real estate as well. So if you flip a property, buy a property and sell it within a year, then at this time, the last time I checked, you are susceptible to short-term gains, which means that whatever that profit is going to be taxed at your real income tax bracket. So if you're in the 30% or 40% tax bracket, then you're going to be paying 40% on that profit. So it's not going to be as good of a return. So that's why your profit has to be pretty substantial to justify that, right? But if you keep a property for a year or more, it goes into the long-term capital gains. And so you're limited. I want to say it's currently 20% last time I checked. Again, consult your CPA. But I believe long-term is currently 20%. And so again, if you're in that 30 or 40% tax bracket, you're paying half the taxes. So what I like to do a lot when I'm even flipping properties is I'll buy a property, I'll keep it, I'll rent it out for a year. After the year's over, then I'll kick the renter out, I'll fix it up and I'll sell it. And that way I get the flip for the gain in the property value, but I pay lower taxes. I think it's a really good way to do things if you're really trying to maximize your dollar, minimize your exposure, because you still want that velocity of money going, but if you're giving up half of it to the government, screw that. Keep your money, right? The team that you really need to amass, and this is where it's where you can't learn it all till you jump in. I know a lot of people that are paralyzed by analysis. Going back to my story about Abel P, he had come in, he had bought his first house, bought his second house, did it 3 times. The guy keeps on leveraging real estate, and he's got over 400 doors. I talked to him a couple of weeks ago. 12 years later, he's got over 400 doors, meaning 400 rental properties. And he started with the first and second, just like I described. So that's the best way to get into it. So as you amount your real estate team, what does that look like? Well, the key players I would make sure that like, and trust, and you double check are going to be who's going to help you assess a value of a piece of property, right? You don't want to be in for option money, earnest money, inspection money, time and energy, only to find out that the property you're buying isn't worth what you're buying it for. And certainly if you're thinking about doing some sort of flip scenario, you got to make sure that whether it's an appraiser that you pay for, that's a good appraiser, or a great realtor that understands the market and gives you a CMA, which is a comparative market analysis, that is good, because any crackhead realtor can do a CMA, but not all realtors are equal, just like all lenders aren't equal, just like all doctors aren't equal. So just because they can do a CMA doesn't mean that those numbers are real. A CMA is like if you're doing a flip, you want to find out, if I did these repairs or added this bedroom, what would the house be worth afterwards? So it's critical that that number is right, because you're making a lot of big money decisions based on it. So interviewing and getting to know realtors, especially realtors that deal with investments regularly, they understand all the jargon like cash on cash return on investment. What's your cap rate? They understand timeliness, accuracy. They err on the side of caution and are conservative. Even better, if they put their money where their mouth is, that if they can't sell for a certain price, they'll discount their fees a little bit to help offset whatever those losses are. I'm not encouraging realtors to give away their money, because I do believe that realtors earn it, especially the good ones. But at the end of the day, making sure you've got a great realtor that can give you a good estimate of value at the time of purchase and will be worth with repairs after the fact is super important. They also can do comparative market analysis on what it's going to rent for. So now when you're buying a piece of property, you can meet with a lender. The lender's the second one, to make sure that A, you qualify, B, you know what the terms are, and now we can compute an actual monthly payment if you're going to do like a buy and hold scenario. Yeah, but you got to know, is it going to cash flow or not? So what's the rental income going to be? If you ask around 3 different realtors what the top 3 agents or top 3 lenders are in the town, more than likely you're going to have at least one overlap. That one overlap or 2 overlaps are probably ones you want to talk to. And again, you don't want to just take it for face value. Quiz them on, how many rental properties do you own, Mr. Lender? How many investment properties do you have you dealt with in the past personally? Because, for example, I'm an investor myself, so it's really easy for me to give advice to my clients that tell people what I would do and what I have done, not what I read in a book one day a long time ago. Speaking of books, another great book to read is called Millionaire Real Estate Investments. Millionaire Real Estate Investing, is a great book as well. But yeah, the realtor partner, the lender partner are probably the 2 first starting blocks. Outside of that, obviously an appraiser, if you're trying to do it a little bit on your own, but an appraiser is going to make sure that they assess the value of the property. A surveyor, you don't want to buy a property that is actually built on the wrong side of an easement. And you want to know where the easements are, because if there's an easement that says that you cannot build in this 10 feet because of an electric line underground, you don't want to buy that thinking you're going to add on an extra bedroom and bathroom into that backyard if you can't do it, right? So that's super important to understand. Past the surveyor, inspectors that are up to date with code, so they can go through and it costs $300-400, best money you'll ever spend, to avoid finding out that, hey, this most recently rehab property I was going to live in or buy for investment, the mistake that I made, isn't up to code, right? So there's going to be problems. So they're going to go through and find out what's up to what is and isn't up to code, and tell you what repairs you might have to do. A general contractor. And this one, you're going to ask around for referrals for sure, because the good ones are few and far between. But a good general contractor that, while you're in the option period, before you bought the property, can go through there and give you within a reasonable expectation. Yeah, there's always something comes up, but with a very small variance of what it's really going to cost to repair this to the way you want it to be. A great general contractor is worth its weight in gold. I've gone through dozens, and I've landed on one that I love and I keep. I don't even say his name because I want to use him for myself. He's amazing. But a general contractor is super, super, super important. Obviously, you can add in trades individually, like electricians and plumbers and painters, because you want to know, especially if you get into this in volume, that you're going to get some level of discount over time if you're going to do a lot of volume with somebody. Title companies are super important because a title company is going to make sure there's no previous liens or encumbrances on the property itself. The last thing you want to do is buy a property, especially cash, and not go through a title company or getting title insurance. I think is super important to do, because you want to make sure that there's not a tax lien on the property, because that supersedes all liens. Like the state can and will take your house from you, right? If you owe taxes, or if there's another lien on the property because the previous homeowner did roof work but never paid the roofer. You want to make sure there's that insurance in place to protect you from any previous liens or encumbrances, so that you have clear title the day that you close on the property. I've got a great title company reference that we use all the time. All right, another couple people that you should have in your arsenal that you should be interviewing. I think one that's super, super important is a property manager, okay? A property manager is somebody that's going to take on the workload of listing your property for rent, vetting potential renters of your property, They're making the house ready. They manage the cash flows ins and out. If you have to evict somebody, they do the eviction process. In my opinion, a property manager is worth its weight in gold. There's a couple local ones here in San Antonio I'm happy to refer you to. I've used personally Red Wagon Realty forever. That's who I personally use. I know that Peace of Mind Property Management's another great local company as well. But the point of saying that is that I'm a finance guy, so I know how to balance the books, and I property managed myself for a couple of years for a couple of properties. At the end of the day, when a pipe busts on Christmas Day, if you're the property manager, you get to field that question. So that's why I think it's worth the 10% of the gross revenue that it takes to have a property manager. So that's one of those things to factor in and interview, because you want to make sure that property manager is good at leasing it out quickly, great at keeping up with repairs. You want to make sure that they are good with the books and there's a transparency of where money is going. They're relaying to you the appropriate tax information at the end of every year. It's a relationship you should build off of, because a lot of property managers, once you get your third, fourth, or fifth property, there's a little bit of a discount over time. So as you build your portfolio, having that relationship is important. And guess what? Property managers also know investors that are trying to sell their properties. So it's a great source of a relationship. If you're the first one that they call and say, hey, Josh, there's this other investor that wants to get out of the property, they're retiring, they want to be done with all investments, you might be able to sweep in there and take over an already tenant-occupied property, and maybe at a little bit of a discount. So I think a property manager is super important to understand. I might go with my notes here. Another person to keep in mind is an engineer and foundation repair people, okay? I've always said an AC people. So the three biggest costs associated with rehabbing or fixing up a property or owning a property are always roof, foundation, and AC. Roof, foundation, AC. So in AC, you can typically offset by just paying for a home warranty. If you don't want to have a big $6,000 dip into your pocket every couple of 10 years, then home warranty is a good way to offset that. You pay $400, $500, $600 a year. When it goes out, it's covered. But roofs, unless there's a hailstorm or major, wind, it's not going to be covered except out of pockets. That can be a big ticket item. So knowing a good roofer that can quote it correctly and not gouge your eyeballs out. And the foundation people, holy cow, foundation people. You can get 3 different quotes from 3 different foundations companies on the same house, and literally one will be $6,000, one will be $12,000, one will be $20,000 on the same house. I have found this to be an ugly area of the business because there's supply and demand. There's not a whole lot of people who want to tunnel underneath the house and jack it up. And if they're super busy, they'll just charge you whatever the hell they want to charge you, and you'll take it or leave it. And so getting to know some of those people, especially if your inspector or engineer says that there's a foundation repair issue, you got to know what you're getting into before you own the property. So I'd say that's super important. One last thing I'd also like to add on is approaching what's called a 1031 exchange company. If you don't know one or know of one, you can ask a title company. They'll typically give you some referrals for this. But a 1031 exchange company is, there's a way. So going back to, I want to flip a property within a year, but I don't want to pay 40% on it. There's lots of rules that equate to a 1031, but basically the gist of it is that if you sell a property through a 1031 exchange and you never put your hands on the money itself, so the day you close, the money goes to title. Instead of the title company sending the money to your bank account, they send it to this 1031 exchange company. Then there's some protections that the IRS gives that if you identify a new property or several new properties that you're going to buy with the money in the 1031 exchange, if they're identified within 90 days and closed on within 6 months, then it's a tax deferred, not tax free, tax deferred exchange. So you can move the money from this property over into these 2 properties that are like in kind or different or bigger. And now I don't have to pay taxes. So this is a way to build on your wealth over time. It's a really great thing to research because especially if you're selling within a year or you're selling and there's going to be a big old pile of money that you're going to owe taxes on, you want to defer that as long as you can so you can keep your money working for you. Now, one aside in this, and this is the last position I would add on that you should have involved, is a CPA. There are so many tax advantages to rental properties, so many I can't even count, that you need to have a great CPA to walk through what closing costs you can write off, what repair costs you can write off, how you can structure this in a way that gives you some additional protections on your property. And I should actually add in an attorney. I think a lot of people honestly should protect themselves and not own a property in their own name. Once they're doing real properties, it should be an entity like an LLC or an LP, because if somebody sued you, you would want to make sure that that's limited to the property itself and not to all of your assets. So a CPA and attorney would probably round out the team that you'd want to amass over time. So start with realtors and lenders. Past that, contractors. Past that, the rest of your financial team, which I'll get into in a different podcast. But overall, what I can tell you is this: in my personal wealth, I can account for, of my existing cash invested in the bank's stock market right now, that more than 35% of that was generated by doing spec homes, speculation, rental properties, and property flipping. And it's just because of staying involved in the industry. Yes, I've had some losses, but with a little bit of foresight, a little bit of knowledge, a little bit of working with better and better referring partners and trusted advisors, I've been able to mitigate the risks of real estate to a level that I can accept. And that's the thing that you're looking for, is what level of risk are you willing to accept? Because with big rewards, there are typically bigger consequences too. So with big gains, you can have big risks. And so just make sure you do your homework up front. I don't think that you should ever get into investments without having a mentor of some sort. Find a real estate investor that has already done it and is doing it at a high level. There's plenty of investment groups to get involved in. There's plenty of chat groups to get involved in. There's plenty of coaches that deal with this stuff. But you want to talk to somebody that's not, that didn't do it 20 years ago, but is actively doing it now, and kind of know the local traps, the local resources, and just ask them for help. You'd be amazed how many real estate millionaires were given guidance on their way up, and they're happy to give you guidance on your way up. So finding a local real estate mogul, for lack of better terms, would be somebody that you should approach and say, hey, listen, Bob, I've heard amazing things about you. I've been told that you've been a local legend. You've bought 100 doors, or you're able, and you have 400 doors. I'd love to sit down with you to bend your ear, buy you coffee, buy you a drink. And obviously, if it's still shut down in San Antonio and we've got social distancing, I can still do a virtual happy hour with you. And let's get to tell me what to watch out for, what to do, and what not to do. Because a good mentor will talk you out of investments. A good mentor will make sure that you've got enough cash reserves. A good mentor will tell you why not to buy something rather than to do something, just to make sure you've thought about what you don't know, right? But all in all, when you really get down to it, whether you buy it and hold it to live in, buy it and hold it to get rental income, buy it and hold it to speculate on a key corner or commercial property, which is a different subject altogether, or whether you buy it to flip it quickly, there's lots of ways to get involved in real estate. You're not going to ever learn until you jump in and get your feet wet. And I'll tell you, come into the water is warm. But that would be the starting point for sure. If you have additional questions or comments, please like or subscribe to our channel. I'd love to hear from you. Go ahead and comment below, or share this with somebody that you know that might be thinking about buying, selling, or refinancing and might need some real estate advice. Otherwise, until next time, I am your host, Josh Sigmund. This is Sigmund Sense, and we'll see you on the flip side. Bye-bye now.